Troy Kearns bringing it to you from Las Vegas in my office here, and today we're going to get into what are the best loans that you need to have when you start flipping properties. We're going to go through each different loan, what it's used for, how you can qualify. So make sure you stay tuned all the way till the end, because I'm going to get into the specifics on which loan works best for which situation and how you can get a loan even if you don't have credit. If you're looking to get into real estate, this is the first place you need to start, because if you're gonna borrow money and you're not filthy rich, you don't have a silver spoon in your mouth, you're going to need to borrow it, okay? So before we get into it, please do us a big favor by helping us smash that YouTube algorithm by smashing the like button, hitting the notification button, and subscribing to our channel. Let's get into it. So you just got your contract signed. Now what do? How are you gonna get the money? How are you gonna fund this deal? So whether you're getting your money from a traditional bank or some other type of lending source, there's a few things that you need to know before you flip property. What loan you're gonna get is going to affect you, and which loan makes the most sense for what type of property that you're buying. The most common type of a loan when flipping a house, and the most common and most utilized and most recommended by me, is going to be a hard money loan. If you look up a hard money loan on Google, it's simply going to tell you, the Wikipedia definition is that it's an asset-based loan. It's also referred to as a loan for land or loan for house. What does that mean? The loan is not based on your credit worthiness. It's not based on your ability to pay back. It's not based on anything other than, did you buy a property at a good value? And traditionally, hard money lenders in general are looking at a 75% to value. So if the property is worth $100,000, you better have it at $75,000 or below, minus the cost of repairs, right? That would be called after repaired value. So if it's worth $100,000, you need to put $10,000 into it. You better buy it for $75,000 minus the $10,000, which would be $65,000, right? So knowing your numbers before you borrow is a key component. Let's get into the hard money loan and why it's different than everything else. First of all, it has nothing to do with your personal credit. If you're a deadbeat, you don't pay back your bills, but you're good at finding deals, you can probably get a loan, okay? Because the worst thing that's gonna happen is you're not gonna pay this loan back, and they're gonna take your property from you, because that's the collateral that you're putting up. So let's get into what is the collateral, right? If you're not getting a loan based on your credit worthiness, your worthiness to repay because you're a new investor, you're brand new to the game, you've never bought a property, then chances are you're going to have to get a hard money loan. So what is a hard money loan? Like I said, it's an asset-based loan. So generally it means that the lender, it could be a private individual or it could be a major corporation. There's guys who loan hard money that have been loaning hard money for years and years and years. Guys that used to flip houses, now they just rather lend their money out. And there's also traditional financial institutions like Lending Home. That's the personal hard money lender that I use. If you want my personal representative, comment below and I'll give it to you. No problem. Let's just run through the hard money loan real quick so that you understand. First of all, you don't need to have a good credit score. Second of all, you don't need to have any income. What do you need? You need to absolutely make sure that you know your numbers, that you've locked down a property that's a good deal, good value, and that you've taken out the repair costs, because a hard money lender is going to require that you are buying the property right. They're going to do their own due diligence to make sure that you got a great deal on the property that you're asking to borrow money for. The other thing that you need to know about a hard money loan is that you're going to pay points. What are points? Points is a generic name for a percentage. You're going to pay upfront points, right? Not really going to pay them. It means you're going to fund them into the cost of your loan. So you're going to say, let's say you got a $100,000 loan. Typical hard money loan is going to be between 1 and 4 points or percentage points on that loan. So if it's $100,000, you're going to pay between $1,000 and $4,000 just in fees upfront on the cost of that loan before you even pay any interest on the monthly. Let's talk about that monthly interest rate. That can range based on how many loans that you've done with a particular hard money lender, or how good your reputation is, how long you've worked with them. But the best I've seen is like 8.5%, and the worst I've seen is like 22%. Most hard money lenders, generally speaking, they're between 10 and 12%. So we're gonna use those numbers as being the most common. So hard money as 10 to 12%. you want to do some really easy numbers, you're going to be paying about 1% per month on that loan if you're paying 12%. Just know your numbers, know how much it's going to cost you to borrow the money, and build that in as a cost of the acquisition. So if it's $4,000 for the points, and then you're going to pay $5,000 in interest, you're going to want to add that $9,000 to the cost of that house and minus that from your ARV, which is going to be your sales price, minus your closing costs, minus all that stuff, so that you can make sure that you don't go broke flipping houses. What are the requirements to get a hard money loan? Generally speaking, you're going to have to put some sort of money down, unless you have a reputation or a relationship, or even better, an obscene deal. You find a deal that's so silly that anybody would be a fool to loan it to. In fact, they're hoping that you default on your loan.
Sir, perhaps you know them. Franklin, Grant, and Jackson.
So that they can get the property that you got at a great value. The qualifications are, generally speaking, you're gonna need to put 10 and 25% down. They will not loan anything lower than $50,000. I'm gonna have to put 20% down, so that's gonna be like 10,000 bucks, and they're gonna finance 100% of the repair. So that's the cool thing. I only have to come up with my down payment, and they're gonna finance 100% of the repair. To front the repair, but they'll reimburse me after I pay for it. So I'll get my money back right away. That's cool. So besides having a down payment, you just have to understand that you're gonna pay a high interest rate every month, and the longer that you hold on to this deal, the more money you're not going to make, because hard money loans are expensive. If you're looking to just try to apply for them, there's multiple national hard money lenders. I've got several of them that I work with. One thing that is key with hard money is you can buy multiple property. They don't care if you've got high debt. They don't give a crap. They only care, did you buy the property right? Generally speaking, they're never gonna waive any of their fees. And make sure when you're dealing with a hard money lender that you're dealing with the lender directly, and that you're not dealing with a broker. And let me explain why. If you're dealing with a broker, you're gonna add more points and more points. That broker is just a facilitator of that loan, and there's so many hard money lenders that you don't need to go through a broker anymore. You just need to Google hard money lender in your state and you'll find someone. Don't go through a broker. You'll just add more points, and it's really probably not gonna be their specialty. Next, we're gonna get into a traditional mortgage loan. Generally speaking, if you are doing a traditional mortgage loan on a property, it's going to be a cosmetic fixer. Let's get into what the traditional types of mortgages are and how you can qualify for them and what the requirements are to get a loan with them. Depending on the level of flipping that you're gonna be doing, you're going to need to make sure that you have your financing lined up, right? So if you're gonna be doing like new construction, we'll call that flipping, you would wanna get a new construction loan. And let me get into what a new construction loan is. That's saying that you have a piece of dirt, right? You can buy the piece of dirt with a construction loan, or you can buy the piece of dirt and use that as collateral for the construction loan, and then you're going to use the construction loan to construct the property. So generally not really a flipping loan, more like a construction loan. Washington Federal is a major bank that does a lot of construction loans that I would recommend. USDA, you can go directly with them, get a 0% down new construction loan. But construction loans for this purposes are for properties that are not constructed already or have not finished construction, right? They don't have their COA, their certificate of occupancy. They don't have their certificate of occupancy, which means that you're gonna have to get a construction loan. So another thing that you need to think about with that, you're gonna need to get builder's risk insurance. All right, so what builder's risk insurance is, that basically covers you on a couple different routes. It covers you if you're building the property, covers your contractor if you have your contractor building the property, and it basically covers, like, if anything happens during the phase of construction, you're gonna be paid back so that you can rebuild it to the point it was at when whatever happened. So let's give an example. Let's say I'm building my house in Kansas City, which I'm working on right now. And let's say I got all the lumber there, and then somebody decided to burn my house down, because it's happened to me several times, right? Someone burns my house down, I'm gonna be recouped, I'm gonna be able to rebuild everything because I have builder's risk. Or let's say, God forbid, somebody falls off a ladder and goes into some sort of hospital and has to get help. That's gonna cover me from liability. Builder's risk. When you're flipping property and you're not using a contractor, or you are using a contractor, you wanna make sure that you have builder's risk. All right, renovation loans, right? That's a conventional type of a loan that lender is going to appraise the property as if it's repaired, and they're going to allow for an amount of money to repair it. Common form, great FHA loan for a first first-time home buyer and or flipper, or if you want your first-time home buying property to be a flip, this is a great way to do it. Get an FHA 203K loan. It's just an FHA loan, but the 203K allows you to double check this data, but $35,000 worth of repairs on that property, and that changes all the time. The FHA 203K is the best loan if you're doing it as an owner-occupant, or if you're planning on owner-occupying and then possibly selling it when you're done. That's a great way to position yourself to get the best deal on the house, because sometimes, like Fannie Mae, Freddie Mac, HUD, they'll have certain restrictions that won't allow anybody that's an investor to buy those properties. So if you're buying it for your primary residence, you're gonna get a break and be able to get an FHA loan and get everybody out of your way, and you're gonna be able to buy that property without much competition if you're using an FHA loan and you're buying it during the restriction period. Basically, a renovation loan is exactly the way it sounds. It's a loan that has some money built in there for you, and based on when you get those renovations done, you'll be able to draw on it, and likely you'll be able to draw a little bit ahead of time, but it depends on which bank you're working with. Generally, banks won't let you take the money out until you front it. But make sure you have the cash to front the loan, or that you have the tools and supplies to do the loans. And just to give you a little bit of a drift off on the FHA 203K, you do not have to use a qualified contractor. You can actually do the repairs yourself, or you can have somebody else that you know do the repairs. If you have any questions about the FHA 203K loans, lenders who are licensed in multiple states, they probably can help you. All right, the cash out refinance loan. This is a loan that we sure have used the crap out of, all right? So generally speaking, when you're doing a cash out refinance loan, you're looking to take your equity out of your property, refinance it for a lower rate and term, and then either reduce the term of the payments or stretch the payment out. Cash out refinance, it simply means that you're pulling cash out of your property, similar to what the hard money lender sees, your conventional lender sees. They see that you have a substantial amount of equity built up, you have the ability to repay it based on your credit, and you're going to be able to take a chunk of money, take it out, spend it on whatever you want. They don't care. You gotta tell them usually what you're planning on doing with it, but it doesn't have to happen. You can say, you know, I'm gonna put a new pool in, and then you can buy yourself a Ferrari. You know, it doesn't really matter. As long as you're not violating the terms and loans obligations and you check with your lender, you should be all right. Where I have used a cash out refinance is where I actually have, you know, a lot of times when you have equity, the first place that you wanna go and the easiest place, and the next loan we're gonna talk about, is gonna be what is referred to as a HELOC, or home equity line of credit. The problem with that is, though, after you get a home equity line of credit, you gotta pay it back if you max it out, right? So then you wanna do a cash out refinance to put those two loans into one, because when you have a home and equity line of credit, that usually assumes that you have another traditional mortgage, and then you have a secondary home equity line of credit. So when you're doing a cash out refinance, you can combine both of those loans into one, refinance them into one loan, cash out if you have any more money left, and take out both the two loans and make them into one loan. Make sense? All right, so requirements to qualify for any of these loans, with the exception of hard money, it's all gonna be credit score based, okay? So typically, if you got a 620, you're gonna need to put more money down. So 620 and below, don't even bother applying. It's like, they tell you with the FHA, they can get you down to a 580. In my past experience, that's just a teaser number, you're never gonna get it. So if you don't have a 620 and above, don't even plan on borrowing any money, because you're gonna get taken to the cleaners. Obviously, if you are getting this property for such a great deal, the interest rate and the amount of down payment really are negligible. So don't get lost looking at a great deal and getting hung up on some really basic stuff that doesn't matter too much. Like if you're paying an extra point, how much is that gonna be in the cost of the deal? You're not gonna even own this house for that long. So definitely you wanna make sure you get a good deal first, then you wanna make sure you get a great loan second. Generally speaking, the higher the credit score that you have, the lower rate you're gonna get, the better term you're gonna get. That's gonna present your best resume to the lender who wants to borrow you the money. It's your credit score and it's your income, right? Do you have the ability to repay? And then it's your debt to income ratio, right? Do you make a lot of money, but you're a fool with it, right? Are you like a drunken sailor that's spending money everywhere, giving it to everybody? If you're that guy, they're not gonna loan you money. If you've maxed out every credit card, you have a great job, you make great income, you pay all your bills on time, but you have a great credit score, but you have tons of revolving debt, you got a new Lamborghini, you got a new Ferrari, and you've got an apartment, and you've got this, and you've got this, and you got child support, you got alimony, you got this, you got that, then obviously obviously income goes down, right? Because of all these debts that you have, and the banks aren't gonna loan you money even if you have a high credit score. So high credit score, low debt. That's what you want. Let's talk a little bit about debt to income ratio. So depending on which loan you're gonna get, it's gonna vary, right? So FHA has the highest standard. I think it's like 52%. So if you make $100, they're gonna loan you 52 out of those dollars to buy a house, right? That's really how it works. Make sure I don't jump over our beloved other conventional loans that we talk about all the time, and I'll break them down real quick. We got the USDA loan. That's a conventional loan. It's kind of like an FHA loan, but it's built by the US Department of Agricultural, and that's a $0 loan. So that's a great loan if you're looking to flip properties, and they'll give you extra money to fix it. And thank you for your service, Army, Navy, everybody. Veterans Administration, the VA loan is a zero down loan. It's probably one of the best loans out there, and they also offer rehabilitation financing. So don't forget about those two great government loans. We are wrapping things up quickly, and while we're wrapping things up quickly, I'm gonna ask you for a like, a subscribe, notification button smash, and anything else you feel like doing while I've got you. So let's get into more details. These types of loans are called private and personal loans. I'm gonna use the same term for both of them. Private loan is just another individual who's going to loan you money, and you're gonna promise to repay them. They can do it secured by a deed of trust, or they can just do a promissory note, okay? So if you're looking to get into real estate, can I borrow some money? Hey dad, hey sis, can I borrow some money? Hey whoever, can I borrow some money, right? Obviously, someone who believes in your ability, or if you got a terrible relationship with your family, obviously don't ask them for money, right? It's like, if you've been kicked out for the last 20 years, don't go back knocking on the door saying, Mom, Dad, I'm a changed man, and I'll tell you what, you should loan me some money, because it ain't gonna happen, okay? Private, personal loans, those are just gonna be people that you know who believe in you, who are gonna be willing to loan you money. Obviously, you understanding your numbers is going to be the key for them pulling the trigger. Pulling on their heartstrings is only gonna work for so long, but you need to back it up with actual data. What are the requirements to qualify for this loan? You gotta have a mom and a dad and a sister, or you gotta have some friend who's rich and they gotta like you. You gotta have a good relationship, right? Relationships, relationships, relationships. A similar loan to a home equity loan, I've really never dealt with this, is a bridge loan. And a bridge loan is exactly what it sounds like. It's a bridge to get someplace else. So typically when you're gonna need a bridge loan is if you're going to sell your house and you wanna buy another house, but because you don't have the current debt to income ratio to meet that obligation for you for a current piece of time to bridge something, okay? So give you a real life example. I'm selling my house in Las Vegas. I'm not, but let's say I am, okay? I'm selling my house in Las Vegas, and in order to qualify for the other $2 million house I'm buying in Hollywood Hills, I need to get a bridge loan because they won't loan me the money until that debt, my other house, is off my credit. So I need a bridge loan. Until then, once the bridge loan is done, then that loan's gonna disappear, go away, and I'm gonna have one loan left, and the bridge loan got me through to get to the other side. So it's a great thing. It's a great thing to have in your arsenal when you're dealing with sellers. If they're like, well, I wanna sell you the property, but I gotta sell the property first to qualify. You're like, well, you know what? I could get you a bridge loan and help you get this property, and then I could buy it. And once it comes off, I'll give you some extra money. Just good to know that there's other solutions out there that you can go to if you need them. Finally, we have the last one, which I have never used, but I hope to use it one day, is crowdfunding, right? We have the power of the internet now. Forget all these banks, forget all these relationships. Crowdfunding is exactly what it sounds like. It's a bunch of random people who are believing in your project that you go and put up on the internet, and you put it together, and a bunch of guys click, and they can give you as much money as they want, and they can fund it if they believe in your project. You're gonna offer them terms, you're gonna offer them all sorts of stuff, and they're gonna invest in your project. Generally speaking, a lot of crowdfunding is done in the giving charitable way. So it's not the best way, but it is a way to go get money. And it's a great way to get money if you're just looking for a tool like crowdfunding to go and say, hey, you know what? I don't have a tool. I need a tool, a little widget to go and get people to donate to me. And crowdfunding is gonna charge me a percentage for doing that. So I'm gonna use this tool to go reach out to a lot of people, hit up 100 people, hit up 200 people, hit up a lot of people to go and give me a small piece of money and contribute and be part of my crowd. The hardest part about crowdfunding is you need to put a dynamic presentation together and a dynamic deal, and you gotta have a track record, right? You can't just be some dude who's out there that's never flipped a house, that's talking about it, that's gonna give your dreams and your ideas. You need to have a business plan, and that's gonna take time, and that's gonna take you putting together real detailed numbers and making sure that that is understood by everybody who invests in your project. The other negative when you're crowdfunding is you're giving away your equity, right? You're not giving it away, you're selling it away. And crowdfunding, by its definition, you're diluting your shares, okay? Because you're giving a percentage to the company who's helping you fund it, and you're diluting your share just by funding it, because somebody's got to pay that 20% or that 30% or that 10% or whatever they're charging. Someone's got to pay for it, and that's coming out of the deal, not the deal. Or yeah, anyways. So the good news is about crowdfunding is if you succeed, you're going to take off like a freaking rocket ship, right? But if you fail, you are going to be a pariah on the internet. And you know, man, anybody who's got bad things to say about you loves to say it online. The internet is full of haters. If you don't have a strong backbone, definitely don't go to crowdfunding. If you've got a strong backbone, check it out. It's a great way. I mean, I'm definitely gonna look into it. It's something that I haven't done before, and there's always deals that you're like, man, this is way too big for just me. Let's get a lot of people involved, and then you go out to your sphere of influence and nobody wants to be involved in that. So crowdfunding is a great place to go. All you need to do is Google for places. Let me give you a couple names. GoFundMe.com or Kickstarter.com. Those are the two most famous crowdfunding sites, and this is a great way to get started investing. Once you figure one out, you're just going to want to stick with it. As I've said many times before, I recommend hard money, less paperwork. They understand what you're trying to do, and really it's going to take you off like a rocket ship. All of these other ones are ones to think about and consider, but my personal recommendation, and this is why you stayed till the end, is hard money lending. And if you want my personal reference, his name is Kenton Buckley, and that's why you stayed to the end. So I gave it to you. So hit me with a like, hit me with the notifications, and I'll hit you with his personal contact information if you hit me with a comment. Peace, we're out. That's it. That's all we got. I'm winded, I'm tired, I'm going home.